Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, January 28th, 2015. In this video, I wanted to go over the U.S. Markets, the equity markets. Yesterday, I did cover both the S&P 500 and Nasdaq 100 in a static format. In the chart we're looking at right now, this is a 2-hour or 120-minute chart of the S&P 500 tracking ETF, the SPY. Again, this chart was posted in static form. You can reference that. Really, not much has changed since yesterday. But what does stand out on this chart, are these divergent tops and bottoms. This was a rising wedge pattern back in July. I think it was late July of 2014. This was a trade idea on the site then. We broke down from there, hit the second target. We hit the first and then the second and final target. And at that time, we had positive divergence in place. It doesn't show here, but to the left of the chart, we did have negative divergence in place leading up to the highs within that wedge. So really what we're looking at here is a combination of using chart patterns as well as divergences to help predict the turns or reversals in the market, even using these intraday time periods like this 2-hour chart. So again, rising wedge with negative divergence. We had a breakdown at the lows as that second target was hit. We had positive or bullish divergences in place. A nice rally ensued that set up this broadening top pattern, which was posted as we actually had a short entry here. I posted about the partial rise strategy, where you have a fully mature broadening top pattern, and then you can put a very favorable risk-reward trade on by shorting a partial rise into that pattern with a stop not far above. Again, that all the parameters of that trade were mentioned on the site back in looks like late September. So that went on to hit the third and final target and then some, exceeded that. This was a rip that caught me off guard, and I think a lot of traders. This is one of the rare examples we didn't have any bullish divergences in place, at least not on this time frame or just about anything but the shortest time frames. But yet we went on to make this really strong rally. A lot of that was Fed induced and some other factors in the market. But since then, this is what I'm focusing on now. Since looks like late October, the end of October, the S&P has been in a trading range here, identified by this shaded box. And I think the next major move will be either on a break to the upside or downside. Because of these negative divergences, we have divergences going back all the way from this point, really when this trading range began. In fact, it's almost double divergences. We had, prices making higher highs at this point and then continuing on to make a higher high. Now, I will say we did have a healthy correction at this point. That was about a 5% drop in the S&P. Maybe that was enough to play out for these negative divergences in the near-term overbought conditions, but I'll talk on the longer-term charts in a second, and I think a case can be made that to support my primary scenario that we do get a downside resolution of this trading range and prices move lower in the S&P. Okay, to help support that thesis, here's the S&P 500 daily chart. This is looks like maybe a 4-year daily chart showing a downtrend line coming all the way off the October 2011 lows. Very well-defined downtrend line. We had a break of that downtrend line back here. This was one of the biggest fake-out whipsaw moves I've seen in many years. And this bull market's been full of quite a few of those, but we broke trend lines. This solid breakdown on this daily trend line. We even broke the entire bull market uptrend lines on everything but the Nasdaq, if I recall. In other words, the Russell, the small caps, the mid caps, all large cap indices except the Nasdaq 100 took out those weekly trend lines and prices whipped back up. So that's just an odd occurrence of technical analysis where things don't play out the way at least I had expected, and I think a lot of others. So, with that being said, that doesn't mean technical analysis doesn't work anymore. It's just been a little bit harder in this central bank, manipulated market that we've been in for a while. So what we're looking at here, as I've highlighted for quite a while now, this broadening top pattern. Prices are just now turning off the top of the pattern here. If you look down below, we've had divergences along the way, and these divergences have led to healthy corrections. As I mentioned, there's that. I think that was this was the 5% drop recently. We had that bigger drop last year, and we recently, if you look at these blue lines down here and here, this move up, that latest move into the most recent highs, was a divergent high as well. So the fact that we're at the top of this pattern, prices rolling off, help steer me towards the more bearish resolution of this current trading range that we're in now. Okay, and moving out to a weekly chart here, let's center this a little bit better. This is the S&P 500 weekly chart, going back all the way, encompassing the entire bull market from the lows in March of 2009. This is that weekly uptrend line that I was talking about, the blue uptrend line here, which, we had a few intra-week breaks, but we had yet to have seen a weekly close below this blue uptrend line. And, after multiple touches until this breakdown here. So again, this was, as I refer to, one of the, if not the, most convincing breakdown or longer term sell signal yet that I've seen in this entire bull market. And, as with most either final highs, such as the end of the bull market in 2008, we had a divergent high. To see clear negative divergence on the weekly charts like this is rare. You don't get those often. They come along every couple of years, and it works on the flip side for bullish divergences. I don't have it drawn here, but we had bullish divergences at the 2009 lows. This was midway through, at least to this point, the bull market. We had a divergent high back here. Actually double divergence noted by the blue line and then the dotted black line. Each of those were very sizable corrections. So they did play out for a correction, but those corrections had only brought us down to the primary uptrend line. So what I've added, and I added this line a couple weeks back, this dotted line, or dashed line I should say, is an alternative uptrend line that I'm watching that does connect several points as well. But if you look here, prices after that false breakdown or whipsaw signal, we move back above the trend line, but have once again closed below, and we've had several weekly closes below. So again, even after this fake out move, we had another divergent high. If you notice this most recent high in the S&P as marked by this is what I refer to as double negative divergence. We had negative divergence up to this point, played out for a little bit of a correction, and yet we went on to make another high, but that's another divergent high. So again, taking all of these charts in context, we're looking at the weekly chart here, the daily chart, and then zooming down to that 2-hour time frame chart that I started with. It's the posture of these weekly charts that leans me towards the bearish resolution of that more recent trading range we're looking at on the 60 and 120 minute charts. So that's the S&P 500. Okay, moving on to the Nasdaq 100. This is the QQQ, the tracking ETF for the Nasdaq 100. This is a 2-hour period time frame, meaning every candlestick represents 2 hours of price action. This goes back, well into the last third quarter of 2014. We had double negative divergence up at this point. So what we're noting here are these corrections that follow the divergences. So let's just draw these out real quick. We had, let's try this again. We had this correction following that divergent high. We had another divergent top here marked down, negative divergence on the MACD, RSI, and many other indicators. And there's a correction following that divergent top. Once again, we had the next divergent high here. So you see these are, very high probability, in my opinion, very simple but high probability ways to identify corrections and or trend reversals. Now at this point we don't have a divergent high only because prices have been making lower lows. Now technically speaking, let me see if I can clear those lines out. We're in a downtrend at this point. A downtrend is defined by prices making a series of lower highs, which we have here, that the uppermost downtrend line, as well as a series of lower lows. So in the near term or intermediate term, this is a downtrend, but I'm going to really refer to this more as sideways trading action. I'm not going to try to split hairs. Yes, there's a slightly lower low there. When you view this chart on the daily chart, I have it drawn as a descending triangle, meaning, a flat, almost a flat line here, because it almost appears that way on the daily chart. I just wanted to point out that, this is very similar. I don't have it highlighted here as a trading range as I do on the SPY, but this is the most recent trading range. Although again, we have this is the uppermost trend line to watch. We don't have a horizontal resistance level. It's more of a downward sloping resistance level. So again, let's watch for a resolution of this pattern. Forget about the box, really an upside or downside break in conjunction with the S&P 500. If I were, let's say, an ES trader. ES are the futures, the mini futures for the S&P 500. And I saw a downside break of that pattern. Well, personally, I would hold off on establishing a short position until and unless the Nasdaq 100 and maybe another index or two confirm that. So that's how I like to trade. In other words, if you get a sell signal, you get a breakdown on the S&P, but at that point the Qs are right here at this line, and they happen to catch support there. More than likely, if the Qs bounce, the S&P is going to follow suit, and then you're going to have a false entry. So I like to use multiple indices, multiple time frames to confirm my entry or exits on trading. Trading's all about probabilities, stacking the odds in your favor. So the more check boxes you have for a bullish or a bearish scenario or breakout, the higher probability you are of having a successful trade. Okay, this is the NDX daily, the Nasdaq 100 daily chart. And as I just mentioned, see, I have it drawn here more as a symmetrical triangle pattern. I like that line as well because it comes in and it denotes these earlier highs back in mid 2014. It covers those. So you have, at that point a resistance level. Resistance was taken out, and those former highs have now acted as support, especially when viewed on this time frame. So again, this is what I'm looking for, to see either an upside or a downside resolution of this pattern. Because of these negative divergences in place leading up to that high, the most recent highs, personally, I wouldn't be going long on an upside breakout. I've missed admittedly, quite a few long side trades, especially on the index ETFs. In the last year or so, because of all the bearish divergences and bearish, signs, and I'm fine with that. I've focused my trading in the last year has been heavily focused on the gold and gold, silver, and the gold mining stocks, select commodities, and the occasional long and short here and there. But I just, like I said, this market can go up another 40-50% on the long side. And I'll trade long and short, but I'm not keen, nor have I added any index trades, meaning the Qs or the SPY, in quite a while. But if and when the time comes, and I think that those will make for good swing shorts, I'll be sure to put those on as trade ideas with some downside targets. But as of now, that's what I'm looking at. And if we, just to give you an idea, if we do have a downside break of this descending triangle pattern, as well as a breakdown of that recent trading range on the S&P 500, my next downside target would be this primary uptrend line right here. We're looking at the blue uptrend line, and again, where that comes in all depends on where we break down, but my guess would be somewhere here around the $3,700 price level, which would also come in with this reaction low back from that correction in late 2014. So where I to add a horizontal line there, and we can do that now if you just want to see what I'm talking about here. Let's draw a line from this point, and I'd probably have to move that down a little bit. It captures this reaction high here. If I moved it down, which I don't think I can do on this screen draw software, having a tough time with it, but you get the point. And that would come in and intersect here, so we could see a breakdown, and boom, this would be my initial target area right about there. Okay, now moving out, this is the Nasdaq 100 weekly chart. So now we're looking at, going back a decade or so, and this is a showing you the entire scope. This is the bull market off the Actually, the Nasdaq 100 bottomed in, late 2008, but for the most part, most indices bottomed in March of 2009, and that's where, most consider the bull market to have officially started. So this was that long-term uptrend line, and as I mentioned a minute ago, the Nasdaq 100 has been the leading index, very strong, and one, or really about the only leading U.S. broadly diversified equity index that I follow that did not have a closing weekly, break a weekly close, I should say, below that trend line. When trading off the weekly charts, you want to see a weekly close. This little candlestick wick down here, that was an intra-week break. Prices managed to close back above. So we've yet to break this trend line. And what I talk about often are these divergences, especially on the weekly time chart. So let's just draw it out here. All the divergent tops are marked. We have the RSI up top, and if you look down on the bottom, you'll see the PPO, which I use in lieu of the MACD on longer term time frames. Also, keep in mind that I use on long-term charts, especially, a log scaling. So while this may not look like much, here was the peak in prices back here at the top of that wedge. This was the drop, and that is a significant correction. That was back in '06. All I'm trying to point out here is you would be hard-pressed to find a divergent top on the RSI, PPO, especially both of those, that did not lead to a sizable correction. And this was a double divergence here, so we had this blue line coming up to this point. Prices didn't correct, but then we had an even steeper divergence on both the PPO and RSI, and then we had this very sharp, I believe that was a flash crash, if I'm not mistaken, right there. So again, may not look like much because of the scaling that I'm using here, but those are sizable corrections. And again, so you kind of get the point. And here is clear negative divergence leading up to this most recent high at this point. Yes, we had a little correction, but that was relatively insignificant compared to these prior corrections. And again, price is wedged. It's not drawn here, but had I added another blue line, a little more steeply sloping down, as prices made this most recent high, we had another divergent high. So in other words, I view this as one extension, one continued divergent high into the most recent highs on the Nasdaq. And being that we're in such close proximity to this downtrend line, my expectation is if we break it, that's going to give you a pretty solid sell signal that's going to lead to a correction. I would probably put it, at least in the 20% range, possibly more if and when we get that. Again, according to the way the charts look, but we'll just have to play it as it comes. Okay, so that was really the large caps, the two big indices, the S&P 500 and the tech-heavy Nasdaq 100. This is the Russell 2000 small cap index. This is a weekly chart going back to the 2009 lows. So this encompasses the entire bull market. This is a chart I've talked on recently, talked about these Fibonacci fan lines, the light gray lines, which may be hard to make out on this chart. You have one here. They all generate also off the 2009 lows, and how prices have behaved very well off these lines. And we recently had a breakdown, I should say back in mid-2014, we had a break and a back test of that primary bull market uptrend line as well as that Fibonacci fan line. I think that's the 50% retracement level there, if I'm not mistaken. And prices have been back testing and have started to turn lower. And as I've stated, weeks ago, a couple months ago, my next ultimate downside swing target would be that next fib fan line, as well as maybe this horizontal resistance or support level that I have here. But with that being said, again, we have a very strong, trying to draw out the arrows. Let me just highlight the blue lines. A very powerful divergent high, negative divergence leading up into even the more recent highs as we back tested here on the Russell 2000. So from a longer term perspective, this looks quite bearish. You can see a divergent high here in the RSI. Had I drawn it here, the higher peak here, we'd have a down sloping trend line from this peak. So we had negative divergence at that point. And you see that very powerful, the correction that followed ensued back in early 2011 or so. So again, I do expect more downside, taking this longer term chart into the Russell. Near term, the Russell's been choppy, tough to trade. So we'll just have to wait for some a little bit more clear sell signals to try to pick a good entry for those of you looking to put a swing trade on the Russell. And just to wrap this video up on the U.S. indices, this is the Wilshire. Actually, this is a pretty broadly diversified the Wilshire 5000 composite index, and we're looking at a 20-year weekly time frame. I've covered a similar chart in the past on the Wilshire, measuring out the duration, how each of these bull markets was about 5.5 years or so in length. And they were all defined by, pretty well defined, I should say, by uptrend lines. They all had that in common. And, right shortly after the top, those uptrend lines gave way. That began the new bear market. You can see, I don't even need to draw these out. I think it's pretty clear. And not only did they have the relative time frame, about 5.5 years, we're 6 years now, about close to 6 years or so into this bull market, but they all had divergent highs. This is very simple. I mean, we see these negative divergent, multi-year divergence because we're looking at a long-term weekly chart. The MACD or PPO, RSI, most other price momentum indicators making lower highs while prices made higher highs, and the trend line breaks. So you have the time symmetry, you have the divergent tops, and in my opinion, it's only a matter of time. We did have that false breakdown that I just mentioned there. The Wilshire is going to track very closely to the S&P 500, but there we are again. We're starting to crack through that trend line, divergent top. So I know there's people out there that say the markets will never go down as long as the central banks are printing money. I don't share that point of view. I've tried to call some tops on this market ineffectively in the last year or so, but I'm still a firm believer that there's only so much that the central banks can do. The economy and the stock market works in cycles, in waves, and they've done a hell of a job inflating and driving prices up. And I think a lot of even the future actions of these global central banks are reflected into stock prices. So at some point, you're either a fundamental person or a technical. I use both fundamental and technical analysis, but if given the option to only use one, I'll go with technical analysis every time. And, so when you see this trend line, when we start to see a clear move below this trend line and a solid weekly close, especially 2-3 weekly closes below, following these divergences, taking into account how the scope of this move, the duration of this move, there's a good chance then we've entered the next bear market in equities. But again, we're not there yet, at least not by most metrics, but we could, this could be a month, 2 months away, 6 months away. I still expect at some point this year we'll see a sizable correction in equities, and we'll just have to look for, again, some more objective entries at this point. Have to be very selective in this market on the short side. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.